webinars on student debt, sponsored by National Housing Resource Center. We're going to give people just another minute to get onto the websites of the webinar, so we'll be starting shortly. Thank you. Okay, welcome to the National Housing Resource Center webinar on student debt. This is the third of a series of 3, so we're at the tail end here, and today we're going to really focus on the public service option on government student loans, which is very valuable for your clients potentially who work for nonprofits or for government agencies, and I think has special value because it's also a staff benefit that could really help people who work for housing counseling agencies, and a reason for people to stay in the business longer. So very helpful. We'll spend a fair amount of time on that. That'll be the third of the issues that we talk about. And before that, we'll deal with private loans, so the non-government loans that are available out there and what to do when people get into trouble, and then also loan consolidation. We've got our team of trainees. Hopefully you're getting quite used to them. They're really doing a good job. We have Natalia Abrams and Cody Hunanian from Student Debt Crisis. We have Maggie Thompson from Higher Ed, Not Debt. And we have Josh Cohen, Student Loan Lawyer. This is the final one of the series that we're doing, and we will have a special session on advocacy and what we as housing counselors can do to help improve the opportunities around housing counseling and student debt. And that'll be at the Leaders in Housing Counseling call a week from Thursday, and we expect to have a lively conversation on these topics. We'll also have an update in January, and we'll publicize this widely, but there'll be changes in the student debt, the government loans for student loans, and we want to give people an update on that, and we'll probably do a couple sessions on that for people to have a chance to have the latest information. And we hope to do cycles of more of this in 2016, and we'll let you know. These will be probably introductory ones so we can get more counselors trained, though we have quite a turnout for this first round, and it's clearly very, very popular. One quick note, just to make sure you know, the National Housing Resource Center is a national advocacy program for nonprofit housing counseling agencies. We're 3.5 years old. We've been pushing for improved funding, for better access to credit, for better resolutions on foreclosures, and improved modification systems, and integrating housing counseling more effectively into home purchase and servicing issues, as well as the whole range of things that housing counseling can be involved with, whether it's around rentals, around reverse mortgages, around homeless issues, the gamut of what's out there. And the whole idea is that the housing counseling community should be organized and have a good, coherent voice and really be able to mobilize. So if you're not involved now, please get involved. This is just one of the many things we're doing. I really do want to give a big, warm thank you to our friends at Student Debt Crisis and Higher Ed, Not Debt, and Student Loan Lawyer. They've really stepped up to really help us understand the process and what needs to be done. And with that note, I'm going to, actually one more quick thing. Matthew, do you want to explain to people how to get the handout?
There's a Handouts tab in the GoToWebinar control panel. If you don't see the control panel, you should see a little orange arrow. If you just click that, it'll open up the control panel and open up the Handouts tab, and there's a PDF that you can download.
Good. And then certainly we're going to encourage questions. We'll have a fair amount of time for questions on this call, and put those in the question box. We'll get them in the queue, and Matthew, as our administrator, will bring these to the group, and we'll have time to answer many of these questions. So put them in as soon as you think of them, and get them in the queue. Well, with that note, so Natalia, Maggie, Cody, Josh, we're turning it over to you. So Natalia, are you there?
I think there's an issue with Cody's phone line. See, it says he's self-muted, Natalia, so I'm not sure. I can't unmute him from here. I think he has to do it on his end. Sorry, folks, just 1 second while we get this sorted out.
So as I understand it, they're not in their regular office. They're in Nashville.
Just start. I'll call back in. Hey guys, can you hear me through this microphone?
Yes, we can.
Hello?
Yes, yes, we can hear you.
Great.
Can you hear us?
All right, I'm sorry about that. Yeah, sorry about that,
Okay.
guys.
All right.
Problem.
Let's get going.
Yeah, let's move it along. Sorry, as I was saying, thank you guys for joining us. We know it's been a lot of information, but we're really excited to leave you guys with this last webinar and hopefully tons of information that you need. I just want to start off with introductions. Of course, I'm Cody Hunanian from Student Debt Crisis. We also have Joshua Cohen, the student loan lawyer. Josh, would you like to introduce yourself one more time?
Sure. My name is Joshua Cohen. I'm the student loan lawyer, which means I do anything I can with student loan issues. Been doing this for 8 years now. I help people get out of default. I help them get affordable repayments. I sue debt collectors that don't do what they're supposed to be doing, and servicers and guarantee agencies as well. I defend people when they're being sued on their student loans. I pretty much run the gamut. So if there's an issue with the student loan, I'll do what I can.
Awesome. Thank you, Josh. Next, we also have Maggie Thompson from the Higher Ed Not Debt campaign. Maggie, do you want to give us one more introduction for yourself as well?
So Maggie, we can't hear you.
Oh, can you hear me now?
Yes, yes.
There we go.
All right. My name, like Cody said, is Maggie. I am the campaign manager for Higher Ed Not Debt. We're a multi-organization, multi-year campaign that's really working more on the advocacy side to take on the student debt crisis. Actually, Student Debt Crisis, the organization, and Natalia is one of our founding members. We're housed out of the Center for American Progress, so we focus a lot on policy, but of course, as part of that, have spent a lot of time figuring out ways to be helpful to borrowers as we're activating them to advocate for change on the issue of student debt.
Awesome. Thank you so much, Maggie. And last is our executive director here at Student Debt Crisis, Natalia Abrams. Natalia?
Hi, everyone. Thanks so much for having us. I'm the executive director and co-founder of StudentDebtCrisis.org. Like Higher Ed Not Debt, we are an advocacy-based organization where we specialize is direct connection with student loan borrowers, where we try to assist them to find the correct government program or the correct resource, such as Joshua Cohen or credit counselors and housing counselors like yourself to help aid them with getting out of their student loan mess. So we're really excited to have you all on here today and to talk about private loan consolidation, private loans, consolidation, and something that might be important to you as well, which is public service loan forgiveness.
All right, great. Well, now with introductions out of the way, we can get the presentation started. And I'm going to pass it off to Natalia to get us going.
Great. So I hope everyone can hear me all right. There is a little bit of technical difficulties, but we're going to get moving. So why we're here today is we want to, stress the importance of the student debt crisis with what's going on and how it affects the housing market. And so we're seeing increasingly that family formation is being affected, and millennials are definitely being impacted in terms of their ability to purchase a home. So we're not bringing on the same amount of home buyers as we have in previous decades. And there's a lot of belief, everyone from the Federal Reserve, from the National Association of Realtors concludes that student loan debt is a large part of the ongoing problem. So if you've been with us before, we'll go through this very quickly. Just a reminder, the overall student loan debt is $1.3 trillion, and we are currently adding over $100 billion per year. We have 43 million borrowers with student loan debt, and that is also increasing. And default, if you were with us last week, we talked about the 8 million people that are currently in student loan default. There's another 8 million or so that are in delinquency or struggling to repay their debt. So almost 2/3 of that 43 million are either not paying their debt or close to defaulting on their student loan debt. One of the reasons we feel that this is a crisis that needs everyone's attention right now. And the impact on the housing market. So in last year in the LA Times, this was reported of $83 billion, specifically for households under the age of 40. That for people that owed more than $250 per month on their student loans, it became increasingly harder to obtain a mortgage. To go back to the default numbers, we know that if you are currently not in good standing with your student loan, you will be hard-pressed to get a mortgage. So it's very important that first with your clients, you make sure their loans are in good standing. Then, as we talked about for the first seminar, you look into income-driven repayment options if that's a viable option for your client. And then finally, you know, the holy grail, so to speak, they actually are able to get into a mortgage because everything else under that is taken care of. So now we're going to talk a little bit about private loans. And, you know, if you've been with us with previous seminars, we've steered away from this a bit because most of or all of the programs we talk about are available for federal student loans and not private student loans. But it's important that you can help navigate your client and know what the difference is between the two and how to figure out what types of loans your clients have. So again, a reminder if you've been with us, and we'll go through this very quickly. We have federal loans and private loans. Federal loans are issued by the Department of Education. Now they are called direct loans from the Department of Education. In the past, there might have been FEL loans, which were loans issued by banks but secured by the federal government. Federal loans are need-based, subsidized, which are the very best loans you can get since interest starts accruing 6 months after graduation, or unsubsidized loans. They are at a fixed interest rate. They offer a variety of income-driven repayment options. There is a hardship deferment and default rehab. And as we have loan forgiveness in quotes, again, if you've been with us, you will know that there is no immediate loan forgiveness, but there are programs like public service loan forgiveness and the forgiveness at the end of the income-driven repayment options. For private loans, what we're talking about today, this is based on your credit history. Your interest begins immediately. Most of these loans are fixed interest, but they also can be variable, just like your home mortgage. There are no repayment plans that are offered on any type of large scale, no guaranteed deferment, and your ability to negotiate for default, I'll let Josh get into that possibly at the end, but there's no default rehab in the way there is for federal loans. So real quick, and just for your records, these are the current federal student interest rates. And as you can see, the direct subsidized and unsubsidized loans are a great deal compared to the direct parent plus loan. We tend, when we talk with student loan borrowers, to let them know that they should try to exhaust as much federal financial aid as they can. And also for parents, if it's possible for their child to borrow themselves as opposed to taking out a Parent Plus loan. As you can see, that's over 2.5% higher. And then if all else fails, take out private loans, but we really try to deter private loans. And this is why, because not all private loans are made equal. we do hear of stories of 2%, 3% private loans, but those tend to go to people with excellent credit history and a lot of assets, and frankly, people that don't necessarily need the loans as much as the struggling student loan borrower. They can go as high as 15% interest. You know, that's almost akin to having a loan shark in today's day and age, where you can get a housing loan between 3 and 6% interest. So definitely watch out on the private loan interest rate when you're speaking with your clients and student loan borrowers. All right, so how do you find these loans? For federal loans, there is a website that is from the Department of Education, which is nslds.ed.gov. It's the National Student Loan Database System. And you can go to this website. Keep in mind, for the most part, it's wise for the borrower themselves to do this and then to send their NSLDS report to you. There's a personalized PIN that each student loan borrower needs to obtain this documentation. So the Department of Education gives a suggestion that this should be obtained by the borrower themselves. And again, at the end, I will let Josh talk about the discrepancies with that. So they click financial aid review. That's at any point in time after they've graduated, they can obtain this, or even when they're in school, and you can get all of the information you need to know about your federal student loans. If it is not listed on the NSLDS, most likely it is not a federal loan and it is a private loan. So let's figure out how to find a private loan. So not in the LSDS, ask your client, is there a cosigner? For the most part, if there is a cosigner on the loan, it is going to be a private student loan. Another way to find out if you have a private student loan is on your credit report. Something to note here is to avoid online credit reports that could have a clause for arbitration, which if the borrower then runs into trouble, they could be forced into arbitration. At the end of this presentation, we have a link to a printable form that your clients can mail in to obtain their credit report without accidentally walking into arbitration. And then also, what do their receipts or their bills from their lender say? And you can often find out what type of loan they have there. We find that the credit report and the NSLDS are the two places that we suggest borrowers to go to on a frequent basis to figure out what types of loans they have. So why are private loans so different than federal loans? With private loans, repayment, you can be in default or delinquent after 1 day of non-payment. If you remember from our story last week, there was a student loan borrower that was currently still in school and missed their payment and then was considered in default. It's something to be very cautious about. Again, with federal loans, it is after 270 days that you would fall into default as opposed to 1 day. Repayment plans are not available for private loans. There sometimes are exceptions made between the borrower and the lender, but they're very rare and not something that we would say across the board, here are the repayment options for private loans. They're practically non-existent. Again, when you default, there's not options to get out of default. Deferments, forbearance, they're up to the private lender to grant. And it's not a requirement the way that the federal loans have. Here are the consequences. Similar to federal loans without the so-called get out of jail free cards, there could be a lawsuit to garnish wages, no rehabilitation. With private loans, though, you cannot lose your driver's license or professional license. Also, they cannot withhold your Social Security. I would say these are one of the only benefits of the consequences, so to speak, on the private loans versus the federal loans. Remember from our previous sessions that for federal loans, they can garnish your Social Security, and they can take your driver's license or professional license. I believe it's 22 states, 21 states, it was 22. Less methods to recover debt than the federal government, but same type of consumer protection issues about harassment. I believe also at the end in our resources, if your client is having a problem with their private student lender where they feel that they have been defrauded, unfortunately there's so many things that feel very unethical but aren't illegal, but if you feel that there's something illegal that has happened, you can submit a report to the CFPB online complaint data system about your private student lender. And again, with these private loans, very difficult to discharge in bankruptcy. It can happen, but very rare, and you need to prove a high standard of hardship. With that, I'm going to hand this over to Maggie Thompson, who's going to go over loan consolidation and touch a bit on these debt relief consolidation companies that we all want to make sure stop lying to students. With that, Maggie, take it away.
Thanks, Natalia. So on previous webinars, we had talked briefly about loan consolidation as a tool to help borrowers get out of default. We wanted to go a little more into detail about sort of what is loan consolidation and a few of the features, especially as it's relevant to helping people qualify for programs like public service loan forgiveness. So the basics of consolidation, as the name would suggest, this is consolidating several loans into one bill that in a way that can often simplify monthly payments. One thing to flag about consolidation is that often comes with an extension of the repayment period, which, while that can lower a borrower's monthly payments, will make the total amount paid over that payment period larger. So that's sort of the balance to strike when a borrower is considering consolidating their loans. One of the main reasons to consolidate in the federal loan market is that a borrower may be able to access alternative repayment options or programs like public service loan forgiveness that their original loans may not have been eligible for, and we'll talk through a couple of those examples. And of course, one of the benefits of consolidation, and this is across lending markets, and it applies here, but in a slightly different way, is that you can often switch from a variable interest rate to a fixed interest rate, and depending on the types of loans and where the market is, if you're looking at private loans, you may be able to lower your interest rate. So really the interest rates is, of course, for the federal loan consolidation markets is the weighted average of the interest rates on the loans you want to consolidate, but then it is rounded up to the nearest 1/8%. But once that calculation is made, that interest rate on your consolidated loans is fixed for life. So one important note, Natalia mentioned some of these predatory debt consolidation or debt relief companies. Federal loan consolidation is completely free, and we can't stress that enough because there are several companies that are really going after student loan borrowers that are struggling with their payments and offering to consolidate their loans or sign them up for federal benefits for free. These are free benefits available to borrowers that have federal loans, and we just want to make sure that you all are educated on the options for borrowers so that borrowers aren't falling into the traps. Now again, I talked briefly about the consequences of consolidation. The lengthening that repayment period, again, is going to increase the total amount paid on the loan and the total interest paid, so that is something definitely to consider. And another piece is that just like you can consolidate in a way that will make you eligible for certain benefits or alternative repayment options, whatever the terms of the original loan were, you may lose through consolidation. So if you had a loan that had an interest rate discount or cancellation options, whatever it was, it's just important to, when considering a consolidation, to consider the terms, both of what the new consolidated loan will be operating under, but any potential benefits that you'll be giving up. And really key point is that once you consolidate, it cannot be undone. So this is a decision not to be entered into lightly, and it's very important that borrowers, as they're considering this, are making an educated decision and have a thorough understanding of not just the terms of the loan, but also in the federal context, what repayment programs or loan forgiveness programs they will or will not be eligible for under their new consolidation. So if we want to go to the next slide. So this is about as basic as you can get, just a quick visualization. We're taking multiple student loans, pulling them together into a new student loan and giving a borrower one monthly payment. So there is a simplification piece to consolidation that for a borrower that has several different loans can be a benefit. So, a couple of other reasons just to consider federal loan consolidation is despite the fact that it seems a little not intuitive, you don't necessarily need multiple loans in order to consolidate. So consolidation can be a tool that you can use to sort of essentially change the terms of your loan to another type of loan. So Natalia talked about the FEL loans. These are typically older student loans that were given by private lenders, guaranteed by the federal government. Very recently, the Department of Education has moved towards a direct loan program, which is essentially loans that are directly from the Department of Education without a bank in between. The direct loans will often qualify for more benefits than the FEL loans, these older FEL loans. So if you are working with a borrower that has one FEL loan, but they want to qualify for some of these newer programs, consolidation is a tool that can be used to change the status of their loan from FEL to direct so they can qualify for a program like public service loan forgiveness. It's also a way for them to change servicers. That piece is a little more complicated, but we'll walk through a couple of examples. The other piece is if you want to put an individual direct loan into a consolidated direct loan, that might also allow a Parent Plus loan to qualify for things like income contingent repayment, where a borrower can peg their monthly payments to whatever their income is. And we walked through some of those programs on the last webinar. And as I mentioned at the top, we talked about this in the last webinar, consolidation is also a tool that can be used to get a loan out of default if it's used properly. Again, we can't stress enough that consolidation is complicated, and it's important that a borrower understands the terms of both their current loan and what they would be consolidating into, because it's not reversible. So really quickly, we just have here a list of the federal loans that are eligible for consolidation. You can see the full list here. Natalia talked about the NSLDS ed.gov website. So if you log into that system or have a borrower log into that system, they're going to need to log in themselves with a PIN. They'll be able to see there the different types of loans that they have, and you'll be able to figure out the eligibility there. One flag, one thing that can't be done is private student loans cannot be consolidated with a federal loan consolidation. So if a borrower, has a private student loan from Discover or Wells Fargo or Sallie Mae or any of the larger private student loan companies, they can't consolidate using the federal loan consolidation, but they can speak directly to their lender to talk about consolidation for private loans. And one other note on Parent Plus loans. So people ask, we get this question a lot, I use consolidation as a tool to transfer my Parent Plus loan to the student, to my son or daughter, so that the loan can then be in their name. And consolidation cannot be used to transfer a Parent Plus loan to a student. So just flagging that there. It's a question we get quite a bit, actually. One note about private student loan consolidation, I think the biggest flag here is not to consolidate federal loans into private loans. They should be consolidated separately. We've talked a lot about things like income-driven repayment programs, pay-as-you-earn, public service loan forgiveness. All of those benefits go away if a loan is in the private student market. Natalia walked through some of those pitfalls. So just flagging that. If you do have someone that has private loans already, then the benefits of consolidation can be the same. It's all about simplifying monthly payment or resetting the term of the loan, maybe reducing payments. Maybe if they have a private loan with variable interest rates, they can consolidate into something that is a fixed interest rate. And then just a note on the private student loans, the interest rates on these are based on credit scores. If a borrower maybe has significantly improved their credit score since they originally got their student loan, that may be something that would be helpful to them in consolidating to a lower interest rate on their private loans. And then, of course, this is the private student loan market, so there may be additional fees for originating these new consolidated private loans. So again, private student loans and private student loan consolidation for many reasons can be really fraught and just something to look at very carefully before a borrower moves forward with that. And then we just really wanted to highlight our biggest red flag about consolidation are these so-called debt relief companies or debt consolidation companies. You may have seen some of the ads for these companies. A lot of them are taking out, Facebook ads or digital ads or Google AdWords to try to find students that are struggling with their student loans. And they'll be offering essentially loan consolidation or loan forgiveness programs. They'll be offering to sign up borrowers for a fee. Some of them will even ask for a percentage of monthly payments. Really, these companies are scams because for the most part what they're trying to do is charge borrowers money to sign up for federal benefits that are free. And again, some of the terms or hooks that they use to get people are the idea of consolidation without a full understanding of sort of the pros and cons sounds good to a borrower. If a borrower is confused about how many loans they have, what their terms are, a company that says, hey, we'll simplify this for you and make it one payment every month might be appealing. So that's often part of the pitch. But again, the federal loan consolidation is a free benefit, so they shouldn't have to pay someone to do that. Several of these companies claim to offer lower payments. They use phrases like Obama's new loan forgiveness program or talk about a special relationship that they have with the Department of Education. These are all huge red flags because for a borrower with federal loans, those benefits are their rights and they don't need sort of a middleman to access those. They need to be working directly with their loan servicing company. And again, for us, any sort of processing fee or administrative fee or consolidation fee, that's just sort of a red flag. If you have somebody that's working with a company, that's definitely something to watch out for. Again, federal student loans can only be consolidated through the federal direct loan consolidation program. This is something that can be done fairly quickly. It shouldn't necessarily be done fairly quickly because it is a somewhat complicated decision, but it doesn't take a lot of time and it's free for a borrower to do. So just really can't underscore this enough that people that are struggling with their student loans shouldn't be taken advantage of a second time by companies when they really probably have some options that they could benefit from for free. With that, I don't know if Bruce, if it makes sense to stop for questions now, or if we should jump to Josh and public service loan forgiveness.
So let's take a quick break, and Matthew, have we got some questions in the queue?
Yeah, I'll just run through some private loan questions. There was, I think, a little bit of confusion. Could you just explain whether private loans can be consolidated into federal loans?
No, private loans cannot be consolidated into federal loans.
So if you were consolidating, it would have to be private loans with private loans, federal loans with federal loans, but there's no way those can come together?
Yes, unless you want to consolidate federal loans into private loans, which we would not recommend.
Right. And you can only consolidate once, correct?
Yes, it's irreversible. And was that Josh?
Oh, no, it was Natalia. I was just agreeing with you, Maggie, that it's one-time consolidation for federal loans.
Okay. All right. Could you expand on using the consolidation? There was a lot of interest with the Parent Plus component, but could you expand on using consolidation for Parent Plus loans to be able to do the income contingent repayment?
Essentially, with Parent Plus loans, just like a FFEL loan, consolidation is just a tool that you can use to sort of change your loan into a direct loan. And essentially change the status of your loan so that it's a loan type that qualifies for additional benefits. So that's something that, you know, if a Parent Plus loan isn't eligible for income contingent repayment, consolidating that into a direct loan would then make that eligible.
Okay.
And so the loan would be in the student's name rather than in the parent's name. How does that work?
Oh, I'm sorry. So that was just, so the question that we often are asked is if someone with a Parent Plus loan can consolidate a loan in order to transfer the loan from their name, from the parent's name, to the student's name. And that the consolidation cannot be used to do that. Does that make sense?
Yeah, the Parent Plus loan is in the parent's name.
Yes, yes.
Okay, and could you also explain, there was a question about, I think you had said that basically someone had asked if you cannot use consolidation to take advantage of favorable interest rates. Would you just explain how the interest rate works again?
So it's different between private student loan consolidation and federal student loan consolidation. But yes, so for private student loan consolidation, you can use that to take advantage of lower interest rates in the market. For federal student loan consolidations, it's a little bit more complicated, and that's where the interest rate is going to be that weighted average of the interest rates on your loans that are being consolidated.
Great. Oh, and is there any prepayment penalty when you consolidate?
No.
No, I actually don't know the answer to that. I don't think so. Josh, do you know?
No, they're absolutely not.
And how about any negative effect on the credit report?
No. I mean, the trade line is going to show your old loan was paid off. It's a zero balance, and you have a new loan with in good standing and with current balance. It's just like refinancing a house.
Great. And I think the last question for now, so going back to the scale, and this group had come up before on one of the previous webinars, Student Loans of America. Are any of you familiar with them, and whether they're a legitimate source for consolidation and lowering payments?
If it comes to a federal loan, you shouldn't need anybody. There's no such thing as a legitimate source except for the Department of Education or one of their servicers. The only reason you would use someone else is because you need assistance, in which case make sure that person is qualified. If you're talking about needing assistance for a private loan, well, the only one who can give you a private loan consolidation is a bank. So again, you still shouldn't need a third party to help you do that. It's, you know, you don't get a third party. Well, yeah, you shouldn't need a third party no matter what it is.
Okay. Is anyone familiar with that organization specifically, just because they came up a few times, so it seems like there's some buzz around them at least. Is anyone familiar with them? Student Loans of America?
Nope.
All right. Okay, I think that's, maybe we'll go on from now and we'll double back for some more questions after.
Great. Josh, you want to take it
Sounds
away?
great. Yep.
All right, so let's talk about public service loan forgiveness. And this is quite fun. This is great. This is a great way to get rid of loans for those of you who qualify. I don't do public service, although quite honestly I feel like I do. So let's go into the slide and roll right through this. So basically, let's get rid of the loan forgiveness myths, all right? There's a lot of shady businesses out there that want to charge for loan forgiveness. It's a complete scam. All they're doing is reading the regs and saying, oh, you might qualify, you might not. They talk about the new Obama loan forgiveness. There's no such thing. We work with the Department of Education. Not really. The average borrower, there's little or no options to have the debt forgiven. There are two particular ones we're going to talk about. We're going to talk about you know, public service loan forgiveness and teacher forgiveness. There are rare instances where a loan can be canceled. Those are administrative discharges if the school closes while the student is attending or the student never qualified to be a student in the first place. If the borrower becomes totally and permanently disabled, then their Fed loans would be forgiven, things like that. But barring that, the only way to do it is through public service loan forgiveness or teacher loan forgiveness. Now, public service loan forgiveness began in 2007, so we won't see any of these forgivenesses until 2017. And one popular myth out there is people try to sign up for this program and they're told by their servicer that they can't. And that's true. This isn't a program that you sign up for. It's something that you qualify for and then apply for the forgiveness. And again, since the first one isn't until 2017, we don't even know how to apply yet. The regulations have not yet been written. The forgiveness will forgive any balance remaining after making 120 payments while working at a qualifying employer. So 120 payments is 10 years worth. It's basically you need qualifying payments on a qualifying loan while working for a qualified employer. It's not about what you do for the employer, it's the employer has to qualify. It's any government entity, federal, state, town, county, municipal, whatever it is, or a nonprofit C3, healthcare, law enforcement, fire, etc. And there's a lovely website here, studentaid.ed, you can take a look at and learn more about it. It must be paired with an income-driven repayment. What that means is, very simple, you have to make payments while working the job at the same time. I get a lot of people that call me and say, oh, I've been in nonprofit for 20 years. Well, that's great, but you weren't on the proper payment plan. Let's move to the next slide. And so it began October 1st, 2007. The borrower makes 120 payments. It must be a direct loan. We talked about in consolidation. One reason you might want to consolidate is to take your FEAL loan, a loan that you originated through a private bank, a federal loan through a private bank, and you now want to make it a direct loan. You can consolidate for that purpose. To make it a direct loan, you'll then make qualifying repayment plans, which are income-driven plans, working full-time for a qualifying employer. Now, the definition of full-time under the regulations is 30 hours a week. A lot of employers say, well, our full-time is 32 or 34 hours a week. It's how they get out of paying benefits. It doesn't matter what your employer calls you. It matters how many hours a week you work. If you do 30 hours a week and your paycheck shows 30 hours a week, that counts. If you work 2 part-time jobs that add up to 30 hours a week, both of them are qualifying, maybe one's for a government, one's for a nonprofit, that still counts. So you've got the qualifying employment, 120 separate monthly payments under IBR, ICR, pay, new IBR, or repay. Any income-driven plan. If the borrower has to verify their income, that plan will count. The 10-year standard plan also counts. They make 120 separate monthly payments after October 1st, 2007. The full amount of the payment is due. They don't miss the payment. They're not more than 15 days late, and they don't make less than minimum payment. 120 of those while working for 120 months. On month 121, they're going to apply. And again, we don't know. The payment plans, again, pay, income-based repayment plan, income contingent repayment plan, or their 10-year standard. Now, I'm going to say the obvious here. If you're on the 10-year standard plan, which is 120 months of payments, you won't get forgiveness. The reason why 10-year standard counts is, let's say you can afford the 10-year standard and something goes wrong at work. Maybe you're downsized, or you're as a nonprofit, the budget is cut, something happens. If you can no longer afford the 10-year standard, you switch onto one of the income-driven, but the years you were on the 10-year standard since 2007 will still count. So you're not going to lose anything by downgrading your payment. That's why it's important to look at. Now remember, income contingent comes with a 25-year forgiveness period, and it's 20% of discretionary income. The income-based repayment is also a 25-year forgiveness with 15% of discretionary income. New IBR, pay, and repay, which is coming out, have forgiveness after 20 years and 10% discretionary. But with public service loan forgiveness, you're cutting down the ultimate forgiveness after just 10 years. And the other big difference is the forgivenesses you see on this slide, the 25 and 20 years, are taxable. Public service loan forgiveness is non-taxable. So that's a huge, huge incentive. Let's move on to the next one. Qualifying employment, again, all levels of government organization. It doesn't matter what you're doing. You could be the custodian of a nonprofit, and that counts. You could be a snowplow driver, which we have a lot of them up here. They work for the town. That counts. Other non-for-profit organizations that provide public services. The only sticky situation is where you have religious organizations that are also nonprofit. Any time spent on non-religious activity will count. So even preachers and rabbis and ministers can qualify if they can show 30 hours a week of non-religious work, non-proselytizing. That will count. Even at Catholic schools, many of those are nonprofit. Anytime not teaching Bible studies will count, when they teach English, when they teach math. The IT guy, all of that counts. Contractors for the government agencies or for nonprofit doesn't count. You must be a W-2 employee, not a 1099. Can't be a volunteer either. It's got to be a W-2 employee. Foreign governments or international organizations doesn't count. Must be a United States government agency or a state within the U.S. Again, full-time volunteer services, that doesn't count. If it does, we wouldn't be here right now. We would all be out doing volunteer work right now. And again, religious activities I discussed. There's more at studentaid.ed.gov. Great resource. But you can see where public service loan forgiveness is very useful. Now, you're going to see some of these questions. Do they need to be enrolled in an income-driven repayment plan? The answer is yes, unless they're in the 10-year payment plan. Most of our borrowers are going to need income-driven repayment. Will forgiven loan amounts from public service loan forgiveness be considered taxable income? The answer is no, it is not taxable. Does income level determine eligibility? No, but income level will determine eligibility for the income-driven repayment plan. What kind of documentation do you need to show that you work for a qualifying employer? What I tell people is save your pay stubs, because your pay stub is going to show who your employer is. If you work for the state or a county, it's going to show that. If you work for a 501c3, your pay stub will show your employer, and you can get a copy of the 501c3 certificate through the IRS and other places. What should you do after you've made 120 qualifying payments? Honestly, we don't know. The Department of Ed is just starting to write the regulations. Will the PSLF program exist by the time we've made it? I really hope so. I believe it will. I don't see this on the chopping block. There is discussions of limiting the amount of forgiveness, but that hasn't gone anywhere. The point here is make sure you pay attention to what's going on in the elections, specifically with congressional votes. That, in a nutshell, is public service loan forgiveness. Which federal loans are eligible? They must be direct. Any direct loan. Subsidized Stafford loans, unsubsidized Stafford loans, plus loans for both parents and graduates, and consolidations loans, as long as it is a direct loan. So with the direct parent plus loan, the parent, if the parent works for Red Cross, the parent can have their loan forgiven under public service loan forgiveness. It is available only for loans made and repaid, again, under the direct loan program. Other student loans can become eligible for forgiveness if they're consolidated to direct loans. Again, you can consolidate a FEAL loan over to direct loan, but only payments made while under the direct loan program count. And even servicers are getting this wrong. I still get phone calls from people. They've been paying for 5 years under income-based repayment, but they had a FEAL. And the servicer said they'd qualify, and now all of a sudden they realize they don't. And there's nothing we can do to go backwards. You can't fix it. So it's very important. 1, is it direct loan? 2, do they have a qualifying job? And 3, are they going to make qualifying payments? So roll on to the next slide. This here is an example of the employer certification form. And this is not a requirement. It's a suggestion, but it's not required. Basically what this is, the borrower fills out the top portion that you can't see. They give it to their employer. The employer fills out this form, which will help verify that they are either a government or a nonprofit entity. This then gets mailed to the servicer. Fed Loan Servicing is the servicer that's in charge of tracking for public service loan forgiveness. And what it does, it helps shortcut the system so that the servicer is tracking it. But what I tell people is get a Firebox, save all your pay stubs and proof that you've made your income-based payments, either IBR or pay or whatever it is. Do whatever you can to save, because honestly, we don't know what the process is going to be. Also remember, people will have to continue making payments until they receive proof that they have been forgiven. So this is likely going to take 122, 123, maybe even 124 payments, if you think about it. Move on to the next slide. Okay, and I'm going to hand it off to Cody.
Great, thank you so much, Josh. So before we move on to questions, I know we've already got a lot ready to go. Just a reminder, please join us next Thursday, November 5th at 1 p.m. Eastern Time. We're going to do the advocacy panel on leaders in housing call, and we want to make sure we get as much input from you all as we possibly can. So with that, Bruce, Matthew, if you guys want to get us going on questions, that'd be great.
Great. We'll start with some public service loan forgiveness questions, and then I think we'll double back to some of the questions that have come up on previous webinars that we weren't able to get to. All right. Josh, did you mention, is there a website where someone can go to determine their eligibility of their employment?
There really isn't. They don't need the website. At studentaid.ed.gov is more information. But again, if they work for a federal, if they work for any government entity, federal, state, town, county, whatever it is, or a 501c3, that's it.
All right. And so it has to be a C3, not a C4. Would not be eligible, or any of the other tax exempt.
That's my understanding. Yes.
Right.
So
if borrowers are
better?
looking for a form, on the borrowers.org there is an employer verification form if they would like to triple check, but as Josh mentioned, it is the C3 and the government jobs that are applicable.
Great. Nonprofit university would be included in that, correct?
Yes, it would.
All right. How about, could you go through the impact of missing a payment? What does that do, and does it reset the clock, or what does that do?
No. The 120 payments do not need to be made consecutive. Hypothetically, you could be a social worker for 5 years and then decide to work in a for-profit and then come back 10 years later and you pick up from where you left off. So if you had made 6 years of payments or 5 years of payments, you pick up right there, as long as it's the same exact loan. So let's say you miss a payment. Okay, you just backed up your forgiveness by 1 month. Not a big deal.
Great. And it's fine. There were a few different questions of whether you're going back and forth between different employers. As long as the employer qualifies, each payment you make counts, and it just needs to be that 120 qualifying payments, correct?
That's exactly it. Think of it as units. You need 120 payments at the same time of working for qualifying employer for 120 months.
And I think you covered this, but just to be sure, can a consolidated plus loan qualify for public service loan forgiveness?
If it is a direct loan consolidation, yes.
Okay. Someone asked, they've been at a nonprofit since 2000. Would only the payments that have been made since 2007 count?
That's exactly it.
All right. But a loan that was made pre-2007 could still qualify, but it's only those payments from October 2007 on?
That's exactly it. The age of the loan is immaterial, as long as it's a direct loan and payments after 2007.
All right. Someone said they thought that they had heard that there's a form that your employer can submit each year to the servicer, I guess verifying your nonprofit employment. Is that something anyone's familiar with?
That's the employer certification form that we talked about, and as far as I
Okay.
know, they don't need to send it in every year. You'll need to send it in for each employer, but
Okay.
I'm not aware that you need to do it every year.
Okay. And someone else wanted to make sure that you're saying save pay stubs for all 10 years, all pay stubs to be able to verify that at least 30 hours?
I think so, yes, only because I know the people that are involved in this, and I personally don't trust them.
All right.
Could I just jump in on this 501c4 question? Um, on the form that you flashed on the screen, it said 501c3 or nonprofit organization. So is it possible that you don't have to be a 501c3?
The regulation, go ahead.
Oh, I was going to say, Josh, you might know better, but with churches, but it's 501c3s. We do know for a solid fact that no 501c4s. Just trust me, I run a C4. I wish that that would qualify for my employees, but it does not. So it's just C3s and then churches. And Josh, if you'd like to expand.
Yeah, I mean, yeah, the regs are pretty strict on this one. It's government or 501c3. They say other not-for-profits if they're public service oriented, but the problem is since it's not clearly defined, you're now at the discretion of the Department of Education, and if you've been watching anything, you shouldn't be trusting Ed's discretion.
And this is Maggie. One other note on that is that I know a lot of people work for organizations that maybe have both a 501c3 and a 501c4. I work at an organization like that, but essentially it's worth talking to your HR department to figure out what you're classified as an employee. So even though I work in an organization that has both tax statuses, I am a 501c3 employee, so I would qualify. So don't think that just because you're somewhere that happens to have a C4 that necessarily will, disqualify you.
Great. So how about a borrower who has made a number of payments on several direct loans, then they consolidate them into a single. Does that have any impact on their eligibility or the number of payments they'll need to make?
It restarts the clock because it's got to be 120 payments per loan. So if they had already had, let's say they had 10 payments made and then they consolidate, those 10 payments are done.
Okay.
So it doesn't count.
Okay. So that is something to keep in mind when considering consolidating, I guess.
Yes.
Someone had asked if you could go into a little more detail on for like a pastor or someone who's working at a church and trying to demonstrate that 30 hours of non-religious hours worked, how you would actually go about demonstrating that?
I don't know. I think what we could, no, I mean, because again, the regulations haven't been written, so we don't even know what they're looking for. I think it will be good enough to write a letter explaining, I spend at least 30 hours a week doing X, Y, Z. I spoke to a pastor in Atlanta. She spends more time doing housing placement than she does preaching. Sunday she has a religious activity, but the other 6 days a week she's busy helping her, helping her churchgoers find housing.
I think this really speaks to the point of what Joshua was saying of just keep really good documentation. Because, we haven't seen the first recipients come on board, it's just important for your hours, the type of work you do, your employer verification forms, just, have a folder or suggest your clients have a folder for public service loan forgiveness. So when July of 2017 comes due, you're ready to go.
All right. There's somebody who said when she submitted the letter, I guess it's the employer certification letter, that her loan was automatically transferred to Fed Loan Servicing. Are you all familiar with that, or is that the policy, or is that?
Yes. As I said, Fed Loan Servicing is in charge of tracking public service loan forgiveness. So if someone is not with Fed Loan Servicing and they send in that employer certification to their servicer, that's a flag to the servicer that, oh, you're looking at public service loan forgiveness. They automatically transfer you to Fed Loan Servicing.
Great. I think we have a whole bunch of, there's a few more questions here, but why don't we spend a little time going over some of the other questions from the previous webinars, and then we can double back for some more of these. So these are going to be kind of all over the place, but they're kind of grouped together. First, could you all just give some more information on, starting with Josh, maybe on the services that you provide, what people, when people may contact you, kind of fee structure, and just a little more information, and maybe if everyone could also just, give a little more detail on when people should possibly contact them, and what kind of services you might be able to offer, or help you may be able to offer people.
Okay, and you want to start with me?
Sure.
Okay. So first and foremost, I'm a lawyer, so I am providing legal services. Even when I say I'm not, I can't really say that. People see me as a lawyer, so I'm providing a legal assistance. I start everything off with a 30-minute phone consultation, and I do charge $150 for that. And I do that mainly because I'm tired of the tired kickers. There's a lot of people that want free information, and there's a lot of places to get free information. But what I do during that 30 minutes is we sit down and we talk about everything that's going on with the loan. Most of the people I talk to have federal loans that are in default. So one thing that I request is the NSLDS report that we talked about in our very first webinar. I can look at that, see exactly what's going on. And a lot of what I do is translate and provide clarity to the situation, because debt collectors and servicers are not very good at explaining what's going on. So a lot of the time I'm spending explaining why your loan went up, because you've been in forbearance for a few years. Why is there a collection fee, and why is it so much? So I spend a lot of time explaining that, and by the end of the call we come back to, okay, if you're in default, here's how we can get out, here are the advantages, here are the disadvantages, and I also run through all the payment plans so they know exactly where they're going to be when we get them out of default. And we make sure that that's an affordable payment. There are people that come to me that simply can't afford any payment. And when I hear that, I think there's a budget issue. So I do refer quite a few people to bankruptcy attorneys because sometimes it's what they need. But basically, we're looking at their situation. We're finding ways to deal with it. Now, I will say the other reason I charge for my consultations is because most people don't need to hire me for anything more. The whole point of the consultation is to explain to people how easy this is and to get them a game plan so that they can do it themselves. This is all about self-help. Most people, we decide to consolidate, they do it themselves. The reason why people hire me is they either don't have the time because they're busy, or they just decide they've been harassed so much they don't want to deal with the debt collector anymore. They want me. Under federal debt collection law, when a borrower is represented by an attorney, the debt collector is not allowed to bother that borrower anymore. So one of the reasons people hire me is so that they're protected from the debt collector. So I do that. Other things I do is I'll defend people if they're being sued, and I can only do that in the state that I reside in, both Vermont and Connecticut. So I defend a lot of private student loans. I do defend a few federal student loan cases. I am also getting into bankruptcy and getting student loans discharged through bankruptcy. I've got 4 of them going right now. And I try to keep my fee structure affordable. I always work on a flat fee because I don't like chasing people for money, and I don't want people wondering if their bill is getting higher and higher. It's one fee, easy to deal with. I do payment plans. I take credit cards. I do what I can if someone needs to pay to make sure they're getting the quality service that they need. And that, I think, in a nutshell, is what I cover.
Great, thanks. Cody and Natalia, could you give us a little more on when people might reach out to you and that sort of thing?
Yes, thanks, Matthew. Okay. So we are, advocacy-based, and as I mentioned when we first started, that we do a lot of borrower outreach. So a good time to contact us is, frankly, before you need Josh. When you want to learn about the available government programs, you want to do a kind of quick student loan review. We have borrowers call us daily or email us saying, I need to lower my monthly payments, and then we'll talk a little. Are their loans federal? Are they private? If they're private loans, if they're in default, we immediately refer them to Josh or a bankruptcy attorney. If it's a more complicated federal loan situation, we might refer them to a credit counselor. We, make sure to tell everyone we are, not legally an attorney or a credit counselor, but we are borrowers helping borrowers. So we're a great resource site. Another time to call us, and we've already had some of you reach out, is for these type of trainings. We're really working both at the college level and at the professional level of giving all the information we have and bringing, as an organizer, bringing great people like Joshua and Maggie together so we can talk about the student debt crisis with leaders that can, we feel by helping out, one housing counselor, we can help so many more borrowers than just what we can do in any given day. So, we really are there on the advocacy side, and we have a direct link into the student loan borrower. We've spoken with over 1,000 student loan borrowers this year alone.
Great, thank you. And Maggie, I know you all are more kind of the policy side, but if you could just maybe weigh in a little bit.
Yeah, I think that, really, and this is something that goes for both our organization, Higher Ed Not Debt, and also for Natalia and Student Debt Crisis, because we are advocating for policy changes that would help student loan borrowers. I would say the thing that is really something that we are set up well to do is if you are talking to someone that is really struggling with their student loans and has a really compelling story, I think that we can definitely play a role in making sure, just like Natalia said, directing them to the relevant federal agencies to file a complaint. But also one of the things that we do a lot of, we're based in Washington, D.C., and we are really working to lift up the voices and stories of borrowers to federal policymakers and increasingly state policymakers and state capitals. There are a number of policies that are being proposed sort of across the board. We'll talk about more in our advocacy call. But one example is that the state of Connecticut just passed a Borrower's Bill of Rights that was meant to establish an ombudsman position and consumer protections for student loan borrowers. And that was an effort that we were able to be helpful with by really mobilizing people that were on our list and in our story bank and having them share their stories, whether that's pitching that to press or sharing those with partner groups so they can bring those to lawmakers. So I think the role that we really play in this sort of effort is really lifting up the stories of borrowers. And if you've got someone that's really fired up about their servicer or how much their loans are, or they just really want to take action, I think that sort of funneling that to the right place and into a collective effort to change the laws and regulations around student loan debt is a place that we can be most helpful.
Great, thank you. So just going back for a second, someone did let me know that Student Loans of America is a fee-based service, so it sounds like it was exactly what Josh is talking about, where someone's asking you to pay them for something that you don't really need to be paying someone for. There were a few different questions on scams, but someone also mentioned Student Aid Institute as a company that scammed a group of their clients. But then they also asked if there's any recourse for clients who have been scammed by some of these companies.
Oh, yeah, there is.
Oh, okay. First. Yeah, so I was going to say one of the best resources, at least, to just document is to submit a complaint to the Consumer Financial Protection Bureau. So that would be a first step. And, just a little piece of a little nugget of information. Most of these companies sound like, American student loans, student loan forgiveness, student loan help, student loan relief. They all kind of have those generic sounding names. Most of them will even make you think they are working with the Department of Education. Something we really like to tell our borrowers and what would be your clients is that you shouldn't, if you're not in trouble, meaning you're not in default or really struggling with your private loans, you shouldn't have to pay for student loan help. All of the services we provide are free as an advocacy, on an advocacy basis to all of the student loan borrowers that contact us. It's not until you get in, to the point of needing an attorney, such as Josh, should you pay for any of these problems. And Josh, please tell us about more recourse other than the CFPB report.
So what I tell people is, one, what exactly Natalia said, make a complaint on the CFPB. I also tell them to file a complaint with their state attorney general, because many attorney generals are looking at these guys the same way they looked at debt consolidation and foreclosure rescue people, the same exact folks. The last thing they can do is there are consumer attorneys who can use state laws to go after them if they don't refund the money. many states have what's called an unfair business practice or Unfair and Deceptive Trade Practices Act. So selling something that actually doesn't do anything, like a useless service, is usually illegal under these laws. You can find consumer attorneys at consumeradvocates.org. That's it's NACA, the National Association of Consumer Advocates, of which I'm a member. And all these people do is consumer laws. They're not about student loans. They're about just consumer protection in general. It's worth contacting them. Some states have great laws. Some have absolutely nothing that they can do. But those three things, CFPB, AG, and a consumer attorney.
Great. Is there any advice anybody has for borrowers who are having a difficult time with a servicer? So, for example, they're just not, the servicer's being unresponsive, and then the kind of follow-up is whether there's any regulation of student loan servicers like there is with mortgage servicers.
So the short answer to that to the latter part is no, and that is something that we hope to talk about on the advocacy call, and that the Consumer Financial Protection Bureau has definitely talked about, that they need to make new rules for consumer protections for student loan borrowers. We do not see the same protections as we have for mortgages or credit card debt. So we hope that you'll join our advocacy call. With the first part, again, this is where the Consumer Financial Protection Bureau complaint system is a good avenue. If you are experiencing problems with your servicer, definitely submit a complaint. A little bit obscure, but that's where also with higher ed, not debt specific, and with student debt crisis, submit the story online, and for those special cases, we will do our best to connect that with legislators and the media to get their stories heard if it's something on that line of being unethical but not necessarily illegal.
The other thing you can do, sorry, go ahead, Maggie.
Oh, no, I was just going to echo what Natalia said, and I honestly think because we are in a state where we are sort of ringing the alarm about these loan servicers, I think, calling your representative's office and just, talking to them, sort of doing a complaint through whoever your elected representatives are, might not necessarily get you direct help on your own student loans immediately, but in terms of sort of ringing the alarm as much as possible, I think that's just also a really important thing to help us get more systematic change here.
And the last resource that you have is the Department of Education Ombudsman. You may not get the results you're seeking, but you still want to attempt it, because I've gotten good resolution through them. Their job is to investigate and find out what's going on. The Ombudsman is supposed to be impartial, but you may find out why the servicer is being non-responsive. I spoke to one person who couldn't get a response out of the servicer, and the reason is the loan was in default, and so the servicer didn't really have it. Well, if the servicer doesn't have the loan, there's no obligation for them to talk to you in the first place. Would it be easy enough for them to say, oh, we don't have the loan? Yes. Do they do that? No. Their job is not to make things easy.
Great, thank you. Somebody had asked if anyone is familiar with NSLDS Professional Access. They said they thought it was something that allows counselors and other financial professionals to be more easily authorized to access NSLDS on behalf of clients. Is anyone familiar with that?
I've never heard of it,
No.
but I mean, if you read the FAQs, I agree. The Federal Department of Education is pretty strict about this. They only want the borrower to have access, but if you read the FAQs, they do say you can give authorization to a third party. I don't necessarily recommend it. I even talk to lawyers that I work with. I don't recommend it, but the FAQs do say it is allowed.
Okay. There were a number of questions that came up on discretionary income. Maggie, could you maybe just give a quick, once more overview on discretionary income, how that's defined, and how the poverty level is defined? This is going back to the income-based or income-driven repayment options.
Yeah, of course. So discretionary income, which they're going to use to calculate your monthly payments for income-driven repayment programs, is just going to be your income, your gross income with the federal poverty line, or 150% of the federal poverty line subtracted. So it's essentially just a way to sort of scale the income-driven repayment program, so that if you are a very low-income person who is very close to the federal poverty line, your payment will be close to or at zero.
Great. And then a couple follow-ups is how is household size determined, and how is income determined? Is it pay stubs? Is it tax returns for both? Or
well, for income, there's a certification process that you have to go through each year if you're in an income-driven repayment program. So that's something that, you know, it's essentially updating with the department or your servicer each year what your income was. So that can be a burdensome process, but it's something that borrowers really need to stay on top of. And household size, I actually am not sure how that's reported. Josh, do you know? I believe it's...
Yes, I can tell you exactly how it's reported.
Yeah.
And this is actually, if you read the directions, if you want to slog through them on the IBR applications. Okay, so for family size, 1, your spouse is always counted. Even if you file taxes separately, they still count for family size. 2, any children, whether they live with you or they're non-custodial, that the borrower feels they support at least 50% of the time. And the definition of support is wide open. It's not just financial. It's financial, it's gifts, it's tuition, it's insurance purposes. I mean, if you read it, it's even emotional. So if you take a homemaker, someone that has no income, they can still count all their children, because I would not be the person to say that a homemaker doesn't support their children. You wouldn't say that. So the definition of support is pretty broad. So their kids, they should be able to count, even children that are still in school. If they're supporting them with tuition and other things, that counts. The last part is anybody else living at home that the borrower supports at least 50%. So if their mom or an in-law is staying with them for a significant portion of that year of recertification, and the borrower supports that person at least 50% of the time, let's say a mother-in-law moved in but doesn't pay rent, well, that would count. It's a pretty loose definition. I wouldn't bend rules here, but you know, it's pretty easy to count people. Your spouse will count your kids, and that right there will give you a normal household. The point here is it doesn't matter how you claim children on your tax returns. That is immaterial, different definition. As for how we look at the income, it's also pretty loose there. The standard is to use the AGI, adjusted gross income, from the most recently filed tax return. However, a borrower can use a W-2, they can use pay stubs. If they're self-employed, they can use a profit and loss statement from the last 30 days. They can even do a self-certifying letter stating, you know, I'm self-employed, this is what I do, and this is my income. And the reason that's important is, you know, maybe something happened between the time you filed and the time that you're actually applying for income-based repayment. Maybe your income is different for whatever reason. Maybe you live in a community property state where taxes are a nightmare. If you file separately in a community property state, you still have to claim 50% of the household income. So if you really only make 30%, your federal tax return filed separately will still show 50%. So you can use alternative documentation, pay stubs, W-2, so on and so forth.
great, thank you. All right, how about would consolidating older loans make a borrower eligible for pay-as-you-earn?
No. The bottom line for pay-as-you-earn is, was there a balance due on October 1st, 2007? If the answer is yes, you can't have pay. If the answer is no, you can have pay. So that's the first prong that you've met. Consolidating doesn't help with that bar.
Okay. And this is related, this is also on pay-as-you-earn. So if you have loans that were eligible that were post-2007, but not post-2014, what's the second prong on pay-as-you-earn?
2011. One new loan after 2011.
So could you, if you don't currently qualify, could you just say take a single class, take a loan, and make yourself eligible for pay as you earn.
Yeah, that you could do.
Okay. All right. What should counselors, this is maybe too big picture, but maybe just a quick answer. What should counselors advise a client who is delinquent, or I think they mean in default and in collections, to be able to get onto a income-driven repayment plan?
So, I mean, we talked about this a little bit on our last webinar. So if that person has that resource guide, I think that that's a good outline. But I think the sort of two tools that can be used to get someone out of default, really there's a loan rehabilitation program that they can go through, or also we mentioned briefly on this call, Consolidation is also a tool that can be used to get a borrower out of default and into a program, a loan repayment program that would allow them to enjoy the benefits of something like an income-driven repayment program or something like that, depending on their financial situation.
Great. How about, do you need to be current to consolidate loans?
No, because you can use it to get out of default.
Right. Okay. This I think came up, but I think there are probably some of the folks on the call were not on previous calls. Could someone talk a little bit about what can be done for a person who has loans from a school that is closed and the student has not completed their courses from that school?
It sounds like we're talking about an administrative discharge. Here's how a closed school discharge works. If the borrower was attending the school or had withdrawn within 120 days when the school closed, the borrower can apply for a closed school discharge, and if they qualify, then their loan goes away. If the school didn't close until 6 months after or something, then they won't get a closed school discharge. So quite often I get calls from people that say, oh, my school just closed, I want a discharge, but they hadn't attended the school in 6 years. That doesn't count. It's a really small window that they have to be in order to qualify for that closed school discharge.
All right. There are a number of questions on, the tax implications of the various forgiveness programs. Could someone just kind of summarize with the various income-based repayment programs and then the public service forgiveness program what the tax implications are?
Well, because this forgiveness hasn't happened yet, it's still a little bit up in the air right now. It would be considered taxable income, that loan forgiveness. There are talks of that changing or that being fixed, but right now it's a little unclear. So right now that is definitely something to consider when a borrower is calculating whether or not this would be a good option for them.
And to clarify, we're talking about forgiveness under the income-driven payment plans. If they get forgiveness under public service loan forgiveness, that forgiveness is non-taxable. But if they're doing the 20 or 25-year forgiveness, right now it is taxable. We have no idea where it's going to go. The first forgiveness is going to be in quite a few years. And there's already been legislation brought to make it non-taxable. Of course, it died, but we have no idea. There's also been hints unofficially through the IRS that they don't want to have to chase taxpayers for all of this. It's going to be huge and annoying. So we really don't know.
All right. Someone asked if any of you have any idea when repay will be implemented.
I believe I just saw a press release.
Just
they just announced it today, actually. That all essentially direct student loan borrowers will now be eligible for this new repayment plan called Repay. So it's a new income-driven repayment plan for borrowers with federal student loans. It's very similar to Pay. It's allowing borrowers to cap their payments at 10% of their discretionary income, and it's has a 25-year repayment schedule for forgiveness at the end. So that's one of the main differences is that for Repay, you need to pay for 25 years instead of 20 years in order to get loan forgiveness at the end of it.
And Maggie?
Uh-huh.
Do you know, will that be implemented starting in January of 2016? Do we have a date yet?
You know, I'm actually not sure. I'd have to double check on that. I mean,
Okay,
we
we're
can get
all
back to
combing
folks.
through the press release now, and we will definitely be doing an update at the beginning of the year as we all, figure out this new pay.
I think I saw something that said they're going to enact it July 1st because it's going to take servicers that long to figure out how to do this.
Great. Thank you, Josh.
And why would anybody do that when pay-as-you-earn has a 20-year and a 10% discretionary income? What would the advantage be to repay?
Well, as we were talking about before, Bruce, that if you didn't take out any loans after 2011, you can't qualify. There's many borrowers right now that can't qualify for pay or for new IBR. So it would be about paying 10% as opposed to 15%. So their monthly payments would be smaller. So that would be the incentive off the top of my head. Maybe Josh or Maggie could speak to it as well. But we also, this is something we've been fighting back and forth. I know advocates really wanted the 20-year. Obviously, they wanted the same pay for everyone. This is what we finally ended up with after a bunch of negotiation with the Department of Education.
Yeah, I mean, essentially the president directed the Department of Education to sort of expand pay-as-you-earn or a program like pay-as-you-earn to all borrowers because like Natalia said, to qualify for pay-as-you-earn, you have to have loans that were originated after October of 2007. So this essentially expands the universe of people that will be able to qualify for an income-driven repayment program. So it's not the same as pay, and yes, pay-as-you-earn is definitely more generous if you qualify for it, but if you're someone that has a loan that does not qualify for pay, maybe you got it before 2007, repay is an option that will be available to you. So it also, of course, a part of the problem is, I'm sure folks on the call can tell us that we talked about this in our repayment webinar, is that the number of repayment options is really complex, and I think that, this is another sort of piece to consider as people are looking at their options with a borrower.
I'm definitely happy to hear about it. So, I'm sorry? Okay, so why don't we just do one last question. Natalia, you may or may not have an answer to this, but going back to the statistic you showed of how much money the federal government is making off of student loans, do you have any idea what they're doing with all of the money that they're earning, charging interest to borrowers?
From my understanding, and I'm not a policy person, all of that money actually goes into the general treasury, so that it doesn't go back to the Department of Education per se, and it goes into general treasury. So we've seen projections anywhere between 50 billion to 150 billion, as Senator Warren has said. This is, I'm going to actually paraphrase her. This is not, a great thing to see the federal government profit off the backs of students. She was much stronger, but I'll be a little more polite here. But yeah, it goes to general treasury, and therefore it's not that we can just pull that to pay for more students to go to college, unfortunately.
All right. Thank you all so much. I'm going to turn it back to Bruce, but I think we'll wrap up the Q&A for now.
Excellent. Thank you very much to all our presenters, and thank you for everybody who's participated. This is the end of the series of 3 webinars. We will have our advocacy call Thursday in a week to talk about what role housing counselors can play on the advocacy side on this. But it's been a very helpful, and really appreciate all the questions that people have asked. Very important subject, an area we'll keep working on, and we'll figure out if when we should do the next update on the new program, understanding that it only starts in July. We may not do the update in January, but we will do another cycle of these as well in 2016. So with that note, thank you everybody for everybody's participation.
Thank you, Bruce.
Thank you.
Thanks, everyone.